episodes. Will you recommend the Job Guide 360 interview guide to prospective job seekers?
Sure, I will. The guide is detailed and very comprehensive.
Okay, let's unpack this. Today, we're doing a deep dive. It's really a masterclass in high-stakes financial advising.
Yeah, definitely. Our source material is fantastic. It's an internal guide, sort of an interview breakdown for becoming a successful UK mortgage advisor.
Exactly. It's not just theory. It feels like a shortcut to understanding the technical stuff, the regulations, the ethics.
All of it. And that's really the mission here for you listening, whether you're maybe going through a mortgage application yourself or you just need to grasp the basics of responsible lending.
Without reading dense textbooks.
Right. This is your accelerated course. We're boiling down the essential skills you need in this financial advisory world.
Okay, let's jump straight in then. Section 1. The core mechanics. We have to start with interest rates. They basically drive the whole market, don't they?
They really do.
It's common knowledge the Bank of England's base rate is a huge factor, obviously. But what are the other big things moving the needle on the rate a client actually gets?
Well, it's quite dynamic. The base rate is the main lever, yeah. It dictates the cost of borrowing for lenders. But you also have to look at those key economic indicators.
Yeah.
Things like inflation, employment numbers, general economic health.
Right.
These really impact lender confidence, their appetite for risk. If things look uncertain, well, lenders want a higher premium.
That makes sense. And it's not just a simple reaction to the Bank of England either. We hear about swap rates, bond markets. How do those fit in? They seem a bit more obscure.
Yeah, they are a bit more complex. Swap rates, for instance, they're sort of the underlying cost for lenders when they offer fixed rate mortgages. If a lender fixes your rate for, say, 5 years, they use the swap market to hedge their own borrowing costs down the line. So if the market thinks rates are going up in the future, swap rates climb now. And that makes today's 5-year fixes more expensive, even if the base rate hasn't moved yet.
Got it. So the big picture is set by the government, the markets. But the rate someone actually gets is always personal. Creditworthiness, deposit size, we know they matter, but what do they really signal to an advisor?
It's all about risk, really. Stratifying risk. Creditworthiness tells you about reliability, how well someone's managed debt historically. A poor score means higher risk.
And the deposit.
The deposit size measures the lender's security. If you've got a 40% deposit, the loan to value, the LTV, is low. The lender's only risking 60% of the property value.
Which is much safer for them.
Exactly. Much lower risk profile for them, and they reward that with a better rate. Simple as that, often.
That clarifies the risk reward nicely. Okay, let's move to the absolute bedrock, calculating affordability. We know advisors look at income, but how do they responsibly and ethically assess someone beyond just the salary figure?
You absolutely need the complete financial picture, a holistic view. The assessment has to take in all existing debts, credit cards, car loans, student loans, whatever, and crucially, regular living expenses.
You mean like day-to-day stuff?
Yeah, exactly. Childcare, utility bills, even subscriptions, commuting costs, and thinking about future costs too. The advisor's job is to make sure that monthly mortgage payment isn't just possible, but genuinely sustainable.
The source talks a lot about that sustainability check, particularly stress testing against rate rises. But doesn't that sometimes create a payment ceiling that feels, unrealistic compared to someone's actual spending? How do advisors handle that?
That's a really good point. And managing that is a key advisor skill. Stress testing is a regulatory thing. It's a necessary safety net, right, against future shocks. But let's say the test shows the client could technically afford £2,000 a month. A good advisor looks at their real spending and might say, okay, the lender might offer this, but based on your lifestyle, your savings goals, maybe we should aim for £1,600.
So guiding them towards comfort, not just the maximum possible loan.
Precisely. Financial comfort, not just stretching to the absolute limit.
Okay, once that comfort level is set, they need the right product. Let's go beyond just listing types. When should an advisor actually recommend a fixed rate over a variable? What's the thinking?
It really comes down to the client's attitude to risk and maybe their view on where the market's heading. If someone hates uncertainty, needs a really strict budget, or if everyone expects rates to rise sharply,
then fixed rate is the obvious choice.
Absolutely. It buys payment security, 2 years, 5 years, sometimes longer, peace of mind.
And variable rate products like trackers. Who are they good for?
Trackers and other variables are more for clients who have a bit more financial cushion, maybe, or people who genuinely believe rates might fall. A tracker gives the most direct benefit if the base rate does drop. But crucially, they have to be ready for the opposite.
Prepared for the volatility.
Exactly. They accept the risk of payments going up potentially quite quickly for the chance of maybe getting lower initial rates or benefiting from falls.
Right. And then there's the most complex one, interest only. This sounds risky for the average person. When is it actually suitable?
It is high risk, which is why it's so tightly regulated now. An interest-only mortgage is usually only suitable for, say, experienced homeowners or maybe high net worth individuals, people who have a really solid, credible, proven way to pay back the capital at the end.
Like what?
Could be the large investment portfolio, maybe an old endowment policy, or plans to sell another property. The key is proven. The advisor has to meticulously check and document that repayment strategy, make sure the client isn't just, hoping for the best.
And tying all these checks together is the final gatekeeper. Underwriting. Can you define that simply? Why does it matter so much to the advisor?
Underwriting is basically the lender's detailed risk assessment. It's forensic. It matters hugely to the advisor because the underwriter is the one who gives the final yes or no based on that risk score. They check income stability, credit history, the property valuation.
Making sure all the boxes are ticked.
Every single one. If the advisor hasn't done their homework properly up front, the underwriter will find it and the application hits a wall right there.
Okay, that sets us up perfectly for Section 2, the regulatory guardrails. We've talked about the checks, but they exist because of rules. And this is where it gets really interesting. The Mortgage Market Review, MMR. Why is that seen as such a game changer?
Oh, MMR wasn't just a small adjustment. It was a fundamental shift implemented by the FCA. Before MMR, the focus could sometimes be just on whether you could afford the payment today. MMR forced everyone, lenders, advisors, to look ahead. Sustainable lending.
The forward-looking perspective.
Exactly. It mandated that stress testing we talked about. Its main aim was protecting people from mortgages they couldn't handle if rates went up, learning the lessons from the 2008 crisis.
So it really shifted the advisor's duty from just getting a loan done to protecting the client's long-term financial health.
Precisely. It means advice has to be clear, thorough, suitable. And the advisor needs proof documentation showing why this specific mortgage was the best option for that client's specific situation.
That brings us to the practical rulebook, MCOB, the Mortgage Conduct of Business Rules. What does MCOB actually mean for an advisor on a day-to-day basis? What's its real impact?
MCOB governs pretty much every client interaction. Practically, it demands total transparency and fairness. An advisor has to be crystal clear about the service they offer. Are they whole of market, tied to certain lenders?
The fees as well.
Absolutely. All fees, commissions, charges disclosed clearly upfront. And crucially, MCOB ensures the client gets a suitability report explaining why this product is being recommended, with time to actually read and digest it.
No ambiguity allowed.
None. It protects the client from being pushed into something unsuitable.
With that level of documentation needed, continuous learning must be essential. How does an advisor even keep up with all the changes?
It's a constant effort. Seriously, you have to actively monitor updates from the Financial Conduct Authority, the FCA. They release new guidance all the time, plus regular training CPD, continuing professional development, reading industry news. Compliance isn't something you do once, it's ongoing.
And the consequences of not keeping up
Can be severe. Fines, losing your authorization to practice. It's taken very seriously.
Okay, beyond protecting consumers, advisors are also on the front line against financial crime, anti-money laundering, AML. What does an advisor actually do regarding client funds and ID?
It's much more than just checking a passport. They have to verify identity, yes, but also really scrutinize the source of the deposit funds.
Where did the money actually come from?
Exactly. If a client turns up with a big deposit, the advisor needs to be comfortable. It's from a legit source, savings, inheritance, selling another house. Something verifiable. If something feels off, maybe a sudden large cash deposit that doesn't quite fit, the advisor has a legal duty to ask probing questions, not just assume it's okay to get the deal done.
And all this involved handling incredibly sensitive personal data. GDPR and data security must be huge.
Paramount. Financial PII. Personally identifiable information is highly sensitive. Advisors must use secure systems, encrypted emails, secure document storage, and follow GDPR principles like data minimization, only collecting what's strictly needed. Client confidentiality is everything. Breaching that trust is catastrophic.
There's a heavy weight of responsibility, which leads us nicely into Section 3, the human element. You could know MCOB inside out, but if you can't connect with people, build trust. You won't last long, right?
Absolutely not. This is a people business, fundamentally.
So what are the core communication skills needed to build that credibility, especially when you're talking about huge sums of money, life-changing debt?
I think the first skill is translation. Mortgages are full of jargon, APRC, LTV, ERCs.
Alphabet soup.
Totally. A good advisor listens actively to understand what the client really wants, asks clarifying questions, and then explains the complex bits in plain English. Demystify the process. And regular updates are key. Even just a quick email saying, still waiting on the valuation, it manages anxiety and shows you're on top of things. Builds that trust.
Let's tackle the tough one, the declined application. This must be a really difficult conversation. How do you handle that with empathy but also strategy?
It is tough, and it's a real test of the relationship. The worst response is just shrugging it off. The advisor needs to immediately find out why from the lender. Was it a mispayment, income issue, too much existing debt? Pinpoint the reason.
Okay.
Then communicate that clearly but empathetically. Acknowledge the disappointment. But then you pivot straight to strategy. Okay, here's what we can do.
Like concrete steps.
Yeah, personalized, practical steps. Maybe let's focus on clearing this credit card over the next 6 months. Or let's aim to save another X amount for the deposit. Keep them supported, keep the door open for the future.
This brings us right to that ethical tightrope. Balancing sales targets, which, let's face it, pay the bills with giving genuinely good, compliant advice. How does that work in reality?
That's the core tension, isn't it? Look, the only sustainable way to do it ethically is to put the client's needs first. Always. If an advisor pushes someone into the biggest possible loan just for a higher commission, even if they can technically afford it, that's short-sighted. It risks problems down the line, resentment.
Reputational damage, too.
Big time. But if they guide that client to a comfortable, realistic budget, they build trust, get referrals, build a solid business long-term, quality advice is the best sales strategy, ultimately.
But practically, facing target pressure, how do you stick to that? Especially if you know a lower commission product is actually the right one.
You lean on the regulations we talked about. MCOB forces your hand in a good way. You have to recommend the most suitable product. You document why that lower commission option is better for the client. The suitability report is your justification, your defense. It enforces accountability.
That focus on finding the right solution often requires some creative problem solving. Can you elaborate on the source's example of dealing with tricky income situations? Like irregular income.
Yeah, that's a great example of where a really good advisor shines. So the client has fluctuating income. Maybe they're a contractor, self-employed. Income isn't the same predictable amount each month.
Which standard high street lenders often don't like.
Exactly. They prefer neat pay slips. So the solution isn't forcing them into a product that doesn't fit. Instead, the advisor uses their market knowledge to find a specialist lender, one who will look at alternative income proof, maybe 3 years of tax returns, company accounts.
More legwork for the advisor, though.
Definitely. They have to really understand the client's finances and then explain that complex income structure clearly to the underwriter. They become the translator, the advocate.
And finally, managing those clients who walk in with, let's say, unrealistic expectations. Wants the dream house on a minimal deposit and salary.
Yeah, that happens. You start by listening. Acknowledge their dream, their goals, show empathy. But then you have to gently guide them back to reality. Use the facts. Often the affordability calculation does the hard work for you.
So instead of just saying, no way.
Right. You say something like, okay, based on current rates and your affordability assessment, the maximum sustainable loan the lenders are likely to offer is X, which gives us a purchase price around Y. Let's focus our search there and see what fantastic properties fit your key requirements in that range.
Patience and facts.
Patience, facts, and staying empathetic diffuses the tension.
This has been incredibly insightful. Let's quickly recap the 3 core pillars for success we've pulled from this guide.
Yeah, they seem really clear. First, rock-solid technical knowledge, understanding products, markets, how it all fits together.
Right.
Second, unwavering commitment to regulatory compliance, living and breathing MMR, MCOB, AML, the whole framework.
Driven by that spirit of protecting the client.
Exactly. And third, arguably most important, client-first communication, empathy, transparency, building genuine trust through realistic advice.
And the source material really hammered home that preparation isn't just about knowing the rules. It's about active research, like doing a SWOT analysis on your own firm or competitors.
Yeah, knowing strengths, weaknesses.
And staying ahead of industry trends, technology like AI and lending. It's about looking forward.
Anticipating, not just reacting. Which kind of leads us to our final thought for you, the listener. If getting ready for a role like this involves deep research into a company, its market position, future trends, what could you learn about your own field using similar strategies?
How could you become that person who sees the next challenge or opportunity before it even arrives? How do you make yourself indispensable?
Something to think about.
Definitely something to ponder. Apply those insights to your own world. Until next time on The Deep Dive.